Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. We're going to start off with the US-Iran war. Clearly, there's been a further escalation, and the net result of that is that traffic through the Strait of Hormuz has practically ground to a halt. And it is a choke point for about 20% of global energy supply. And as a result of traffic grinding to a halt, as one would expect, energy prices have increased, particularly oil, which is up again this morning. At the time of recording, Brent is sitting at about $90 a barrel, and WTI is about $84 per barrel. In addition to that, refining margins are very elevated. So it's one thing to see crude prices going up, but refiners are also making extra margin on turning it into diesel and gasoline. And the net result of those two factors is that gasoline prices are increasing again across the globe, and particularly in the US. And that implies that some of the good news we're going to talk about shortly around inflation in June may well be reversed in July or August, depending on when those numbers are measured. We're going to come back to that point shortly. But in the interim, if we have a look at markets, there's a strong theme developing at the moment, which has been a pullback in the shares that have done very well, semiconductors in particular. There's concerns around the potential return on investment for all the hyperscalers, and concerns around potential competition for LLMs coming out of China. And the net result of those two concerns has been that semiconductors are now down about 20% in the US, while the S&P 500 is still close to its 12-month high, and the equal-weighted S&P 500 also still close to its 12-month high. So it's a particular theme that's panning out for these stocks, these momentum stocks that have done so well over the past 12 months. And the discussion point is quite timeless. We've seen a new release from China, and that threatens a repeat of what we saw when DeepSeek was released. And it is likely to be quite significant for markets, and this sector has become very large. So it is something to keep an eye on. And there is this question around how sustainable AI capex is likely to be. Okay, coming back to inflation. We've now had inflation prints for close to 40 of the 50 largest countries across the globe. And what we saw in June was a decline in inflation, a welcome decline. And if you look at what percentage of countries saw inflation surprise on the downside, it was close to 50%, and last month it was 50% too. The point being that over the past couple of months, we've seen a sizable portion of inflation prints across the globe surprise on the downside, which is quite different from what we saw in 2022, where inflation increased, and it increased by much more than had been expected. So this time around, the market's got a much better idea of where inflation is. And in fact, inflation actually for the last couple of months has surprised on the downside. Now, one of the countries that saw inflation surprise on the downside was the US. The latest inflation print was at 3.5%, down from just over 4% and below the consensus forecast of 3.8%. And it's important to note, it wasn't just the headline number came down. The headline number came down because of a negative month-on-month print for inflation, largely due to a fall in gasoline prices in June. Now that may well be reversed in July. But the important point about the US CPI number is that it wasn't just the headline number that came down. Core inflation came down too. And it also surprised to the downside. It came out at 2.6% versus the consensus of 2.8%. And there's a variety of other ways we can measure core and sticky inflation, and all of them declined in June. And that takes some of the pressure off the Fed. If core inflation is heading towards 2%, that provides strong reason to not hike anytime soon. Now, the market's not yet convinced. The market is still pricing one hike from the Fed by December and another hike by March next year. So 2 hikes by March next year as the base case in the short-term interest rate market in the US. Again, if those inflation numbers, the core inflation numbers, continue to decline, the market will shift its view on those interest rate expectations, which should be helpful at least for equities. But in the background, there is a concern around the US deficit. We saw the monthly numbers come out last week, another $120 billion last month alone. And if you look at the rolling 12-month deficit for the US over the past 5 years or so, it's ranged between $1 trillion and $3 trillion. So quite sizable. And the net result of that is that it doesn't seem like the US budget deficit is going to get to 3% of GDP anytime soon, and that's Scott Bessent's target. So we need to see what the US government's going to do in response to this. It seems that austerity is very politically unpalatable at this point. It's hard to hike taxes, it's hard to reduce expenditure. We can expect further attempts to raise revenue through tariffs and an attempt to spur growth in the US, because that appears to be the only way out of this, short of biting the bullet and having to hike taxes or cut expenditure. And shifting to China, we saw signs that the Chinese economy is slowing, and it has been a concern in the back of our minds for some time. We've shown a range of indicators that suggest that the Chinese economy is likely to go through a soft patch, and now we're seeing that in the data. Chinese growth came out at 4.3%, down from what we saw in March and also a bit below the consensus expectation. And that was despite some very good news on the exports front. So it still is quite apparent that the Chinese authorities are struggling to spur domestic demand. They're still relying on exports, and that makes them vulnerable to increases in tariffs in the rest of the globe. And it just is a bit worrying that they're unable to get domestic growth running. And we're going to talk a bit more about that over the coming few weeks and months. And finally, on earnings, it's been a very good earnings season so far in the US. We've had about 10% of the S&P 500 report so far. And of those, close to 90% have beaten on the bottom line. Now, if that run rate continues, it'll be the widest set of beats that we've seen in at least 20 years. So far, so good. And in addition to that, the consensus expectation that earnings growth this quarter will be 26% year on year. Very strong and very widespread. The only wrinkle in these numbers is the companies that have missed, the 10% of companies that have missed. When they have missed, on average, their share prices have been down around 9% in response to a miss. So the market's expecting a lot. And any companies that miss even by a little amount do get punished, or have now recently been punished quite severely. So good earnings season, lots of numbers to watch. We're going to report on this over the coming few weeks. We've got 90 odd companies reporting this week, and then that over 100 the week after. So we'll get an update on this. So far, so good, except for the few companies that have missed. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.